Hey traders, this is Blake Morrow with Traders Summit, and it's Friday. Jim Welsh has to answer the tough questions. What's the stock market going to do? What are bond yields going to do? And what's the world going to do ahead of a U.S. election? So we're going to dig into that all and more right here. Let's bring in Mr. Jim Welsh from Macro Tides. How you doing, Jim?
I'm good, Blake. Hope you're doing well.
I'm going to be doing much better. Like I want to say 2 weeks from today,
Oh,
there's going to be some clarity. I don't even know if that's actually true, but we are definitely going to
yeah,
have a lot to talk about in 2 weeks from today.
yeah.
Probably have a lot to talk about today. I mean,
We
what do you make
better
of
because we're
this?
here. We are.
Yeah, what do you make of these moves? I mean, markets have been all over the place.
Yeah. Again, as I said last week, I thought that Treasury yields would have another tick higher, and that would complete the move that we've seen since they peaked, what, 6, 8 weeks ago, or bottomed, yields going up. I'm thinking of TLT subliminally. And I think that's what we're about to see is a bottoming in TLT, Treasury yields topping out. If I'm right, the dollar, which has been kind of like moving inversely or with, if you will, Treasury yields, as yields have gone up, the dollar has kind of rallied. So if yields start to form a top and then start to roll over, I think that'll lead to weakness in the dollar. In gold, it's had a heck of a move. I thought we'd have another pop above 2740. That happened this week, but the trend has been very strong and positive. And even though there's an RSI divergence, the 5 and 13 exponential moving average are still constructive. So overall, I mean, part of the stock market's move supposedly it's like circular logic. Well, the market's moving up because the market anticipates Trump winning the election. Okay. Maybe, you know, um, uh, but that's one of the things that has been, I think, helping stocks rally and also putting pressure on treasury yields, Blake, um, because the idea being is that the deficit will be bigger under Trump, and that's going to be bearish because it'll increase the supply of bonds that need to be offered. So I just think, and then we're going to, I think, go into the next week or so, as we approach the election, I'm assuming that markets will start to freeze up in the sense of just, okay, what's the outcome going to be? And as you noted, and I think we may have talked about this last week, we're not in all likelihood going to know the results of the election on Wednesday morning. States like Pennsylvania allow mail-in voting. They'll accept mail-in votes that even come in a day or two after the election. But the main thing is they don't even start to count the mail-in votes until election day. And so we're talking, I think, 2 to 3 million votes. Last election in 2020, there was about 7 million votes. So I'm guessing that about 30% or so to 40% will be mail-in votes. So some of these key states are likely we won't know the answer for a number of days. And, what happened in 2020 is Trump had a pretty good lead because rural voters didn't cast as many mail-in votes as people in Philadelphia and Pittsburgh, which are more democratically focused. And so that's why we saw that swing last election. And of course, Trump said that was nefarious and, all the rest of it. I just think we're going to get a repeat. And if Trump wins, I just can't imagine that the liberals aren't going to, in some way, cry foul. They did after the 2016 election. You can see, Blake, stuff online. Hillary Clinton, every other major leader of the Democratic Party in 2016, he's an illegitimate president. He was stolen, blah, blah, blah. So the table's set. Both parties have shown their true colors. They don't like the outcome. They whine about it. I can't imagine unless it's a landslide, which obviously the polls don't indicate that.
And Jim, with that being said, well, the polls may not indicate that, but if you look at the betting markets, it's really, really leaning towards Trump. But I mean, but the polls, will tell you a different story. So it's going to be a really, really interesting time, especially over the next week and a half. I think the volumes are going to thin out, and we're going to see some pretty choppy markets. What do you say?
I agree. I mean, I just think more people are going to say, okay, I might as well just put my hands in my pocket for a while. The one thing about the betting markets, the poly market is the one that shows the biggest, I think, plurality toward Trump. There was an article in the Wall Street Journal a few days ago that there were four trades of $30 million up to, that added up to $30 million that skewed that. So my point is, with the way things are going, both sides are willing to do almost anything to win the election, Blake. So you have these markets, and if you can push them in one direction to get people to think that, oh, okay, our candidate's going to win, it doesn't. Everybody is so polarized. It's frightening in my mind to see what's going on. It really is.
Yeah, and I was just going to show this is Real Clear Politics. This is a amalgamation of or aggregation, if you will, of all these betting markets, and you can see that they are definitely skewed in one direction. But the polls, if you look at actual pollsters, they're more even keeled and within a margin of error. So you got to take it for what it's worth at this point, right, Jim?
I think, I mean, again, I have no idea who's going to win the election. I know both sides will do anything and everything they can, including cheating, if they can get away with it. I mean, sadly, that's where we are. When you get to the point where both parties are lying nonstop, and most people, either in one part or the other, believe those lies, I think that's the most frightening thing about this election, is the willingness to accept untruths from each candidate. I mean, it just shows that the fabric of this country is fraying very meaningfully.
Yeah.
And that, to me, more than anything, suggests the next 5 and 10 years, I think, are going to be really, really tough, because we do have some serious challenges that need to be addressed. And I think the solutions to some of those challenges, like the deficit, the amount of debt, well, you cut back on government spending, you're going to make people unhappy, and you're going to see economic growth slow. I mean, right now we have 3% GDP growth, but the government just ran a 6.4% deficit. That is unsustainable. No matter what I think anybody says, it's like that can't continue. And in the November macro tides, I have a chart, Blake, showing about 10 different countries and what's happening to their debt to GDP ratio. They're all going up. And so my conclusion is governments are either going to have to address that, which will be negative for economic growth. But the more important point, with so many deficits around the world continuing to climb, that means there's an enormous amount of sovereign debt supply that's going to have to be absorbed by demand. And I just think that there's a point where it's going to take higher yields to entice that demand off the sidelines.
Yeah.
And, countries with a lot of debt, it's like, okay, the debt in and of itself may not be that terrible for the economy, but you combine high debt levels that are growing and higher interest rates, I'm sorry, that's a breaking point. It's just a question of how quickly it happens. So I just think that, unfortunately, the next 5 to 10 years, not just in the United States, but globally, is going to be really, really challenging. And both parties have their heads in the sand in terms of all they're doing is preaching their ideology, and there's no willingness for compromise or progress. That's not a good prescription. Anyway,
no, it's not.
I'm sorry about that, but
we live in interesting times, Jim.
Yes,
we do. Hey, let's jump in here and let's start off with your cartoon that you brought us today.
Yeah, a little levity here. I mean, I just saw that's okay. Do all fairy tales begin with once upon a time? No, many of them begin, if I'm elected, I promise. And that's what we're seeing. Both parties and candidates are offering more and more. I mean, Trump even brought up the idea, well, maybe we'll just get rid of income tax. It's like, Okay, you
Yeah,
know.
I was had a conversation about that yesterday. I'm like, tell me exactly how that's going to happen.
Yeah, yeah.
Yeah,
I mean, again, VP Harris is the polls show her she's not doing so well with black men. So she comes out with, hey, you can borrow a bunch of money. You don't have to pay it back. Oh, yeah. And you can start marijuana things if you want. I mean, it's like the pandering is just pathetic.
it is. It is. Anyway, great comment. I love it. But let's jump into the markets here. So,
Okay, this is
you'd
one other
mentioned that
chart.
both parties do like deficits.
Well, here you go. Bill Clinton actually had some surpluses. Part of that was because of huge capital gains that came in 1999 and 2000 because of the tech bubble.
Yeah,
Okay, but nonetheless, obviously, uh, things. Bill Clinton moved to the middle in 1996 to win that re-election. He moved to the middle and he passed a bunch of legislation that the majority of Democrats would be incapable of passing today. All right. But the point being here, we can see there's a definite upward trend in terms of deficits continuing. And that's how we've gone from, deficit of, I think, 30% of GDP had a debt to GDP ratio of 30% about 40 years ago. And now it's 125% and heading high.
and and you wonder why we've had a spike in inflation, right, Jim?
That is definitely, in my view, has contributed to it.
Yeah.
I mean, there were other factors that we all have. I mean, there should be some objectivity in terms of did supply disruptions have an impact? Well, of course, but the extra money that was provided created demand that collided with those supply blockages, and they combined contributed to it.
Yeah.
And again, it's unprecedented to have a 6.4% deficit with GDP not being negative.
Right.
And
Right.
unemployment, like at 6, 8, or 10%. So
All right.
anyway,
Well,
okay.
this next chart you brought, Jim, is the S&P, and obviously we've gone on a tear.
I
This is a
think there's a
30-minute
chart in
chart.
yeah, there's a chart that should be a daily chart.
Oh,
This is
I'll get you the daily chart. It's right here.
Oh, good. Thank you. Okay. So my point is this is an indicator that I developed 30 some years ago, and it looks at market breadth, both in terms of advanced declines, highs and lows, up and down volume. And when it gets below minus 40, you're usually at least a short-term low. And so the vertical lines are showing where these lows came in. During June, as we remember, the overall market wasn't doing so well, but the artificial intelligence stuff was lifting the S&P. So, that one looks a little funky, but that's the reason why. So on Wednesday, this got to a minus 46. So it's kind of saying, okay, we're probably near at least some kind of a low. And I will offer this though, in a bear market where you have real reasons to be a seller, this thing can get below minus 40 more than once as you make some kind of a low. But anyway, this is where we are today. You can see that those lows line up pretty close to, if not almost within a day of a low, close to it. So my point is, in terms of layering time frames, this is a daily chart. The next chart is a 30-minute chart. So it's like, okay, the daily indicator suggests we're in a zip code of a low. Well, now let's look at a 30-minute chart to identify, are we seeing a price low? And what this shows is, and again, the 5 exponential moving average is red, the 13 is green. When the 5 gets above the 13, the red gets above the green. And so what happened in the last couple hours of trading yesterday? It got above. Now, could we have gapped down this? Of course that can happen, But my point is the idea and concept of layering time frames where you go from a daily indicator and then to, if you will, become more precise in terms of identifying maybe a short-term turning point, going to a 30-minute chart, and then using some basic, simple, if you will, trend following indicators like a 5 versus 13 exponential moving average, it can be pretty helpful. Again, you can see over time, 5 moving average crossing above and below the 13, it tosses out a fair amount of signals. Absolutely. Are there whipsaws? Yes. But if there's any kind of a move of 1 to 2%, it gets you on the right side of that trade.
Yeah. Okay. Well, here's the cues. What do you make out of this chart?
Well, again, what we can see, obviously, in an uptrend since the low in August, and we're nearing what I would say is obviously some pretty important resistance. I think the Q's traded pennies above 500 this morning. So if we're going to follow through to the upside on the S&P, I think you need to see the Q's break out above 500. So if they fail and roll over, to me, that obviously would be not positive.
Got it.
As long as we're holding the uptrend, you can draw a similar line on the S&P. It's almost, I didn't put it in here, but maybe I should have now that I'm looking at it. If you drew a line across the tops, Blake, it would look a little bit like a wedge.
Yeah.
And so if and when the lower trend line is taken out, typically wedges result when they break down, sharp breaks. And so, I think that's what people have to be ready for. It's going to happen. It's just, how soon.
Yeah, of course. All right. Well, the next chart you brought is TLT. The bond market has been just slumping. Yields have been rallying. It's factored into my trading this week pretty aggressively in the FX market. So what do we make of this, Jim?
Well, we chatted last Friday. TLT was above that 92.98. My expectation was that bounce to 95.62 was wave 4, and we were going to have a drop down below 92.98. And if TLT retraces 72.8% of the rally from the low we saw back in April, it targeted 91.22. We got to 91.66. So the idea here was on a break below 92.98, you should be a buyer because that looks like we're completing 5 waves. RSI divergence, you can see with the new closing low, the RSI did record by a small amount a positive divergence. Same thing happened last April. You can see where it bounced, went down, made a lower low. The RSI didn't confirm it. Obviously, I talk a lot about 5 and 13 period exponential moving averages. What I would expect now is some choppiness for TLT, and then at some point in time, if things work out correctly, the red line will cross above the green line. So bigger picture, maybe we'll talk about that next week. I just think at a minimum, we're seeing a trading low. At a minimum, I would expect a rally to 95 to 96. And a much larger rally is possible, but we really need to see economic data come in showing more signs of slowing. It's that simple. Because, why did yields back up this much? Well, you had a weak employment report that goosed everything. Expectations that the Fed would cut rates. Ironically, the treasury yields bottomed the day before the Fed cut the funds rate. It's kind of classic market stuff, right? And so a combination of things I think have come into play, but the main one being economic data has been coming in stronger than forecast. And I think 2 weeks ago, I showed charts of the economic surprise index with TLT and with the dollar. And, the correlation very high.
Yeah.
So for there to be a much larger rally in TLT, like we're going to need to see data come in supportive. I think that's going to take a little while. It's not. I don't think it's coming next week.
Got it.
Likelihood. So.
Yeah, of course. Next week's going to probably be pretty choppy. All right. Well, and we have a lot of data next week too. We even have a jobs report next week. So
yeah.
So, but let's talk about the dollar, because the dollar has been on an absolute rampage, Jim. It's been crazy move. That's what a 3-4%, 3.5-4% move in the dollar index just in the last month.
Yeah, 4%. That's a
Yeah.
big move. Now, again, what's happened is at the lows, when the Fed cut the funds rate, again, the dollar bottomed exactly at the time when the Fed cut rates.
Yeah.
And then remember, it inspired a lot of people. Well, they cut 50 basis points. They'll be cutting another 50 either at November and December. And or we might, I mean, all of a sudden people were looking for the Fed to be pretty aggressive because economic data has come in better than expected. Those expectations have been dialed back. That's a tailwind for the dollar. In the meantime, the ECB is giving more signs that, okay, we may have to cut more because their economy looks like it's languishing, would be a nice word, I guess. But the dollar has retraced. When we talked last week, I thought, okay, we may see it push a little bit higher toward that 104 to 104.50. We got there. Again, I think we'll see just like the inverse of the bond market, where we'll see the dollar start chopping around. And I think we're going to see a pullback, at least to 102, plus or minus. And then we'll see the nature of that pullback. If the data comes in progressively, in other words, if we get 5 waves down, like on a 30-minute chart on the dollar index, that to me would be, okay, we're going to see some additional weakness follow that. So right now it's just expectations. It's overbought. I think it's a bit overdone. We're going to have a pullback, and that pullback will tell us a lot. Bigger picture, my expectation is still sometime in next year, first half, the dollar index will drop below 100.
Well, it's a big, bold prediction. We'll see if that is going to happen or not. But the last chart you brought here is gold. So gold has been bullish, and that has not given up much, has it?
No, it really hasn't. The correction after it hit 2684 was ABC, and it held that trend line. So it's like, okay, we're going to get a new high, and we've gotten it. There are RSI divergences, but I think, we need to see more, obviously, selling pressure come in. The 5 and 13 are still positively sloped and correlated. But I think there's a pullback coming. There was a big influx of money into the gold ETFs. And over the last 4 years, Blake, whenever you got a huge surge of money flowing in, you were in the zip code of a high. So sentiment is obviously very bullish toward gold. And I think that, that always makes me a contrarian. But I try to follow what the chart pattern. So when we had the ABC down, I said, okay, we're going to get a new high. And we have. But again, I'm more cautious than optimistic in the near term.
Well, I guess it makes sense to be very cautious in the near term after such a big move. I mean, what's gold up for the year?
It's over 30%.
Yeah, a 30%. I mean, when's the last time you've seen that type of move in the gold market? I mean, maybe back in the 90s?
Well, no, I'm wondering, again, there were 30% moves, whether it aligned with the calendar. Like I think there was a big move, obviously, up into the high of 2011. There was another high in between. I'm trying to remember when it was. But I think, again, 30% moves are significant no matter what market we're talking about.
Yeah, sure.
And those kind of moves attract attention, get people all ramped up bullish, money comes flowing in, and that's typically when you get near a top, at least at worst, a trading, or no, at best, some kind of a trading range. In other words, a pullback to 2,600 to me would be very normal in this kind of environment. Doesn't take away the longer term bullish outlook. It just says that this is not a great place, I think, above 2,700. I thought there was going to be a rally to a new high. We've gotten it. So to me, it's like, okay, time to lighten up again.
So Jim, you're with us every week. Next week is going to be kind of crazy because we have a lot of economic data. We're coming into the elections that are going to be just a few days after that. Do you have any advice to traders going into this next week?
Trade small. Because you pointed out, and I agree, is that there's the potential for a lot of okay. So let's say the election doesn't get decided because it's so close, right? And there's 3 states or something that are like, okay, now we're waiting for them to count the votes in Georgia and Pennsylvania and maybe some other state. And in this kind of environment, there'll be rumors that'll be spread like they're fact. And so the potential for a lot of knee-jerk reactions based on supposed information is just really, really high. When the dust settles, true trends will emerge. And so to me, it's like, okay, be patient, be smart. One does not have to trade all the time.
Right.
So
And I mean, that's no truer words out there. I mean, and I think you said it as far as reduced risk, trade smaller. I mean, it's going to be
yeah,
whippy, right? The next
yeah,
couple of
yeah,
weeks. So it's
yeah.
time
One of
to.
my favorite guitar players, this is the analogy here, is BB King. Okay. And you compare BB King's style of playing with a lot of modern guitarists who can hit a gazillion notes, and it's amazing the technical skill that they have. But I always liked BB King for the notes he didn't play. In other words, he left space so that in a sense each note counted for more. Instead of having 5 notes, he had 1 or 2. And so to me, that comes down to trading. You pick your spots,
Right.
And sometimes fewer notes is I don't know, better.
Well, Jim, yeah, sometimes in trading, fewer trades is a better thing too. Jim, I want to thank you for spending your time with us. What's the best way for traders to follow your work and get some of your recent write-ups?
Macrotides.com, or send me an email, jimwelshmacro@gmail, and I'll send you a recent publication.
Well, Jim, thank you so much for spending your time with us. I always appreciate it. I know everybody here appreciates it as well. And we look forward to seeing you next Friday. It's gonna, like I said, it's gonna be a
Hey, the
new
next
week.
2 weeks, man.
It's gonna be crazy. You guys want to make sure you're giving Jim a thumbs up, subscribe to this channel so you don't miss any of this exclusive content only here on Trader Summit. Jim, thank you so much. And guys, jump down in the comments and tell Jim how much you appreciate him. So
thanks, Blake. Have a great weekend.
you do the same. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.